this in context for us. Are we talking about Turkey this much because it's a slow summer day in August, or is this really meaningful and we can look at the Dow and say, okay, it's weaker because we're worried about some kind of systemic risk coming out from that part of the world?
Well, no, I think financially it's not strategically important. And when you think about the Turkish stock market, it's about $150 billion in market cap. That's about the size of Netflix or thereabouts. And when you think about their currency, that's been going down since 2010, and their debt was downgraded to junk in 2016. So, in terms of strategically in the financial system, not that important. I think when you think geopolitically, they certainly have some importance for security reasons. Obviously, where they sit geographically, certainly they're important to Russia in terms of transmission of petroleum products, into the continent. But, in terms of their overall importance, and, to both your points on the EEM, I think they're about 0.5% of the EEM. I think they're about 1% of the Vanguard Emerging Markets Index. So really, the damage that we're seeing in the EEM, in general over the last month and today is much more related to the strength of the U.S. dollar, I think. I think much less about Turkey.
I'm sorry to interrupt you, but we are showing on the left the live event with Erdogan, seeing if he says any more comments that hurt the lira like he did earlier. And then 3 banks that have big operations in Turkey, and hence they're getting hit pretty hard, between 4 and 5%. And they've been down for most of the week. You're not worried about systemic risk when we talk about the transmission mechanism? Are you worried about banks that might have exposure, and then you have something broader that is problematic, even for our U.S. market?
I don't think this is, a Greece 2.0 and being thrust upon us from Turkey. Certainly, the Eurozone has its host of problems, and I would certainly say Italy is probably more important to that. When they present what their budget's going to be in their plans for next year with their new administration, that's not going to go over well, I think, in Brussels. So to the extent that if you're concerned about the Eurozone and its effect on the global economy, I'd be more concerned about Italy than Turkey right now. Not to be cavalier about Turkey, certainly, for those with exposure to Turkey, this is not going to be an easy ride, and it's going to get worse before it gets better. But I think the Eurozone probably has larger problems than just Turkey right now.
But Art, the discussion we're having this morning is we find ourselves in a world where you not only have trade rifts on multiple fronts, but we're in an environment where sanctions are being tossed around more and more loosely. You got currency, the thought of using currency as weapons. Putin and Erdogan apparently just spoke on the phone. Doesn't that make you want to, think of additional hedges you didn't have before?
Yeah, Carl, that's a great point, but that sort of reminds you of what we've been concerned about since the beginning of the Cold War for trade, right? When this escalates, you get concerned and start thinking about perhaps raising more cash or being more defensive by being a small cap domestic versus large cap and multinational. I think that is still true and consistently true. It feels as though part of the trade war, if you think about North America, conversations with Mexico this week, sound like they're warming. Conversations with Canada coming up next week sounds like that's warming. We're not escalating with the Eurozone in general. That's probably good news. But with China, which is the most important part of this trade war and the trade policy concerns that we have in the marketplace, are getting worse, not better. And I think that's the problem. We don't see an exit ramp with China right now. And unless and until we do, trade is going to be the biggest headwind. We ignored it during a very good second quarter earnings reporting season for a period of time. And unfortunately, when that ends, and that basically ends today, we're going to start focusing on trade and what kind of a headwind that is in the markets. I think that's going to cause the volatility that we haven't seen this week in markets as we head into next week. You get in that news vacuum of no longer hearing corporate earnings and starting to focus on trade again.
Art, getting away even from the individual issues, this whole first half or 2/3 of the year has been about our earnings peaking, is U.S. economic growth potentially going to decline significantly into next year, and what does the Fed do about it? Does all that we're talking about today with the global trade situation and everything else bear upon those questions in a major way?
Michael, that's such a great question. One of the things, that I think that embedded in that question is, does the Fed do anything? I certainly think the ECB has to have a reaction to this, and that's probably not a good thing. But I think, in terms of the Fed, Jay Powell has been agnostic to everything that's been happening in the globe. To a real extent, he's been agnostic to a flattening yield curve and really leaning against a strong U.S. economy while he can to normalize rates. So do we see a change in U.S. monetary policy, or even is this spoken to, at their next meeting when they're going to raise rates in September? I don't know. But I will tell you this. I think that, during the first half, we're seeing incredible earnings results for the S&P 500, 20, pair of 24%ers, and a guidance for the second half really didn't come down at all. And I think that shows the resilience of a couple of things. Lower corporate taxes, but the revenue growth was higher than expected. So I think that, at least for this year, we're probably in a pretty good shape. Next year we're probably seeing high single-digit, low double-digit earnings for the S&P 500. I don't know if that, means we're at a peak or it just means we have difficult comps in 19 over 18.